Ladies and gentlemen, good day and welcome to the Ujjivan Small Finance Bank Q1 FY26 conference call hosted by Equirus Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinion, and expectation of the company as on date of this call. These statements are not the guarantee of future performance and involve risk and uncertainty that are difficult to predict. I now hand the conference over to Mr. Shripal Doshi from Equirus Securities. Thank you, and over to you, Mr. Shripal.
Thank you, Viren. Good evening, everyone. I welcome you all to Q1 FY26 earnings call of Ujjivan Small Finance Bank. Today, we have the senior management team of Ujjivan Small Finance Bank, represented by Mr. Sanjeev Nautiyal, MD and CEO, Ms. Carol Furtado, Executive Director, Mr. Sadanand Kamath, CFO, Mr. Ashish Goel, Chief Risk Officer, Mr. Martin, Chief Operating Officer, Mr. Vibhas Chandra, Head Microfinance Business, Mr. Hitendra Jha, Head Retail Liabilities, and Mr. Gaurav Shah, Lead for Investor Relations. I would now like to hand over the call to Mr. Sanjeev for his opening remarks, post which we can open the forum for question and answer. Over to you, sir.
Thank you, Shripal. Good evening and welcome to our Q1 FY26 earnings call. I will walk you through the business and financial outcomes for the first quarter of financial year 26. Please be informed that references made during this address to Q4 pertains to financial year 24-25 and Q1 and H2 relates to financial year 25-26. About overall business, in Q1 our gross loan book delivered a growth of 11% YOY and 4% QOQ, reaching rupees 33,287 crores. The disbursements in the quarter grew to 6,539 crores, registering a strong growth of 24% YOY. The rising share of our secured portfolio from 31% to 46% YOY underscores the calibrated strategy to diversify our product suite and enhance portfolio quality. The MFIN guardrails too have been fully adopted by the bank effective 1st April 2025. While we had anticipated a slower disbursement, we observed that demand scenario improved and Q1 disbursement in group loan was 2% higher than Q4. We stay aligned to this new operating framework and are focusing on deeper existing customer engagement and opportunities to acquire new customers. Our focus on graduation of good customers to individual loans is also gaining momentum as per our existing strategy. We added approximately 1.1 lakh new customers in microbanking during Q1, while ensuring healthy borrower profiles. Reinforcing our focus on customer life cycle management, we also graduated approximately 34,000 group loan customers to individual lending and also migrated large number of customers to secured products in gold, vehicle, and micro mortgages, a testament to our efforts in nurturing credit-worthy borrowers and driving sustainable growth. Recent regulatory changes were introduced, reducing the priority sector lending requirements for small finance banks from 75% to 60%. This move marks a significant positive shift and gives the bank enhanced flexibility to calibrate its portfolio mix. We believe this will aid in better capital allocation and improve the cost and risk profile of the bank's portfolio. About macros and liquidity, the Reserve Bank of India took various steps starting February 25, including reduction of policy repo rate and continuous liquidity infusion. We believe these measures would bring down the cost of funds and drive higher credit demand in rate-sensitive segments like affordable housing, MSME, and vehicle loans. As part of our strategy to diversify the loan book towards more secured products, we expect the NIM to moderate for the bank. The impact of repricing of deposits undertaken by the bank in the last few months is expected to benefit the cost of funds in coming quarters. Additionally, we carried higher liquidity buffer to meet the large liability maturities in Q2, which is getting absorbed in this quarter, leading to liquidity stabilization. Assets update. In Q1, our group loans stood at 12,961 crores, reflecting an 18% YOY degrowth. However, disbursements in Q1 were up 2% QOQ to 2,844 crores. Our focus during the quarter remained firmly on reviving disbursement, strengthening collections, and improving portfolio quality. Individual loans grew 7% YOY to 5,332 crores, backed by a strong 16% YOY growth in disbursements. This reflects the quality and credit behavior of customers graduating from our group loan portfolio and remains an important growth engine. The portfolio quality in IL continues to be better than GL. Ex-bucket collection efficiency of the microbanking book remains strong at 99.34% for June 25, reflecting repayment discipline. We are witnessing improvements in collections environment and expect to touch normalized levels of 99.5% plus by Q3 financial year 26. Coming to the secured book, disbursement growth of 86% YOY in Q1 was primarily led by a strong 100% YOY increase in our affordable housing and micro mortgages segments, alongside a 212% YOY growth in the MSME segment. Additionally, our FIG book continued to contribute meaningfully to overall disbursement momentum. Others, including vehicle, gold, and agri loans, contributed about 11% of disbursements in Q1 and continue to grow at an accelerated pace. Our housing portfolio, comprising affordable housing and micro mortgage loans, has delivered impressive growth of 53% YOY in loan book, reaching approximately 8,000 crores. Micro mortgages, a higher yielding, lower ticket product, contributes roughly 900 crores to the portfolio, registering a strong growth of 227% YOY and 24% QOQ. As part of our strategy, micro mortgages has augmented the housing portfolio, effectively addressing the sub 10 lakh ticket size segment and complementing our current product offerings. MSME business witnessed an impressive loan book growth of 59% YOY, reaching 2,253 crores. Working capital and supply chain finance now account for over 24% of our MSME book, reflecting the growing traction in our business banking segment. In the other portfolio, vehicle finance continued its strong momentum, with loan book growing to 560 crores, a robust 156% increase YOY and 20% increase QOQ. Agri-banking loan book reached 403 crores, growing 288% YOY and 25% QOQ. Gold loans also gained traction during the quarter, with disbursements rising around 550% YOY, taking the loan book to 293 crores with presence in 280 branches. Our focused efforts in newer product offerings, comprising of micro mortgages, gold, vehicle and agri-banking loans, have started showing noticeable contribution towards the portfolio. Our Q1 disbursements were 628 crores against Q1 financial year 25 disbursement of rupees 190 crore. These are our higher yielding offerings in the secured lending portfolio. Liabilities update. The bank's total deposits grew YOY at 19% to 38,619 crores. Our CASA deposits grew by 13% YOY to 9,381 crores. Retail TD plus CASA deposits stood at 27,884 crores, registering a 16% growth YOY and contributing 72% to total deposits. Notably, retail deposits have remained consistently above 70%, emphasizing the stability and stickiness of customers towards our franchise. Our cost of funds remained at 7.6% in Q1 and shall reduce in upcoming quarters, since we have lowered the peak FD rates by 65 basis points and SA rates have been recalibrated up to 100 basis points in some buckets. In terms of asset quality, the green shoots are visible, with PAR accretion in microbanking showing a consistently decline over the last 2 quarters. Our slippages in microbanking had peaked in 9 out of 10 states in Q4, and we foresee Karnataka peaking in Q1. Slippages are expected to show an improving trend going forward. As was the case in Q4 and Q3 of financial year 24-25, this improved scenario did not necessitate sale of NPAs to ARC in Q1. Bank continued the prudent approach of taking accelerated provisions of approximately 23 crores in Q1 and additionally holds unutilized floating provision of rupees 21 crores as of June 25. Our financial performance. Interest income for the quarter went up by 3% QOQ as the asset book continues on an upward trajectory. Other income increased 26% YOY. It was down by 8% QOQ due to PSLC income, retail insurance, bad debt recovery, and disbursements being lower. This was offset by higher treasury income due to OMO, switch, buyback transactions carried out by the regulator during the quarter. Additionally, collections in the ARC pool have contributed approximately rupees 7 crores by means of provision release towards discounted SRs. OPEX for the quarter reduced by 3% due to lower variable pay compared to the previous quarter and tight control over costs. Major savings came from IT. The cost to income for the quarter stood at 67%. Credit cost improved QOQ to rupees 225 crore from 265 crore, including accelerated provision of 23 crores. Profit after tax for the quarter stood at rupees 103 crores. The return on assets and return on equity were at 0.8% and 6.7% respectively. We would now like to place before you the guidance for the year. Advances growth around 20% with secured growth around 35%. Liabilities growth in line with advances to maintain CD ratio around 88%. The growth should be around 18%. CASA percentage targeted to close at around 27%. Cost to income percentages to remain around 67%. Credit cost to be in range of 2.3% to 2.4% of average gross loan book. ROE to be 10% to 12% and ROA to be around 1.2% to 1.4%. Lastly, coming to the Universal Bank License application, post the submission in February 2025, our application is under consideration of RBI. Before I conclude, I would like to introduce Mr. Umesh Arora, who has joined as our Head of Emerging Businesses. He holds a rich experience of over 25 years and has held senior leadership roles in retail lending, credit, and asset businesses across reputed banks like Axis Bank, IDBI Bank, Standard Chartered Bank, and Utkarsh Small Finance Bank. He would be overseeing the departments of housing, MSME, and agri-banking. Thank you. Now I hand over to Viren.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, in order to ensure that the management is able to address questions from all the participants in the conference, please limit your questions to 1 or 2 per participant. Should you have a follow-up question, we would request you to rejoin the queue. We have our first question from the line of Renish from ICICI. Please go ahead.
Yeah, hi sir. Comments on a good set of numbers. Just 2-3 things from my side. One, on this asset quality piece, so during Q1, we saw most asset quality metrics deteriorating sort of across segments, whether it is gross NNPA, PAR 0, PAR 50, etc. So just wanted to get a sense, is it largely due to seasonality or is there any specific to read into this?
Hi Renish, this is Ashish here. So in terms of PAR, we had a higher PAR in Q1 as compared to Q4.
Right.
This was large, in terms of addition, the PAR addition has started to decline for the last 2 quarters, as Mr. Nautiyal said. However, in Q4, we had done a ARC deal of 300 crores. That had reduced our PAR significantly, and we have not had the need to do any ARC deal in Q1. And therefore, the PAR and GNPA would show a slightly higher number. So, and similarly, the only thing that we have done in terms of intervention is about 150 crore of write-off, which was eligible as per policy. So, with no intervention, the PAR and GNPA numbers have gone up a little.
Got it. So let's say adjusted for ARC sale in Q4, the fresh PAR accretion pace has deteriorated, I mean, has improved in Q1?
Yes, Renish, that is right. The PAR accretion improved in Q1 because our Bucket X collection shows a much better trend in Q1 as compared to Q4. In Q4, we also saw some deterioration because of Karnataka as a state. That factor did not, that factor played out till April. But in May and June, that was not a factor. So our Bucket X collection efficiency also showed an improved trend. We are now at about 99.4% for the last 2 months.
Mr. Ennis, does that answer the question? He has dropped from the question. We can take the next question. The next question is from the line of Pritesh Bum from DAM Capital. Please go ahead.
Hi, sir. Good evening, team. Hi. Just a couple of questions. One is on micro mortgages. The GNPA is now touched at 1%, though the number is smaller. But any color that is there some spillover from the main, JLG or any other microfinance towards micro mortgage as well?
Hi, Pritesh. So in micro mortgages, this book is almost now 15 MOB. This book is now 24 MOB. 15 MOB is where we have built most of our book. Almost 80% of the book is in 15 MOB. There will be a slight increase in PAR as we go forward, as the book stabilizes, as it matures. But, if you see quarter on quarter, the NPA was negligible when we look at Q4 and Q3 of last year. So it will see a slightly higher PAR and GNPA as we go forward, as the book matures. As Mr. Nautya also said, that this is a high-yielding book for us and complements the gap in housing of below 10 lakhs. So it is budgeted accordingly.
Got it. Second, on individual lending as well, we've seen some PAR moving up. You alluded to PAR moving up in the JLG book due to, we had sold some ARC, but in individual lending, we may not have sold to the ARC. So what has the reason been in the individual lending that the PAR has moved up?
As I said, Q4 we had done some interventions in terms of ARC sale. So the PAR had come down, and similarly the NPA had also come down. But in terms of delinquencies, IL continues to do better than GL. That is point number one. And point number two, most of the deterioration that we see in the IL metrics has come from Karnataka. So I would take it as a one-off, and we would see stability in this quarter onwards.
Just to follow up on that, any impact in Tamil Nadu as well? Because there was some movement in terms of bill there as well in collections.
No. So in Tamil Nadu, GL has not been doing as well as we've seen IL. So GL, as we all know, has been an industry-wide phenomenon because of higher leverage of customers. Over-borrowing has been the highest in Tamil Nadu. So therefore, GL continues to show slightly elevated PAR and NPA. But in terms of IL, it continues to be below 2% GNPA, and the PAR has been below 3.5%. Sorry, 4%. It has been in the range of 4%. So TN is doing quite well in terms of IL.
Lastly, the secured yields and the microbanking yields are not much changed. I mean, the secured yields have unchanged and microbanking is down by 20 bits. But the overall yields is down by 30 bits. This is basically only from the mix change, right? Nothing else to read from that.
Yes, it is largely due to the mix change, Pratish.
Yeah. Okay. Thank you. Got it. Thanks so much.
Thank you.
Thank you. The next question is from the line of Rajiv Mehta from Yes Securities. Please go ahead.
Yeah. Hi, good evening. Good numbers. Just a couple of things from my side. Sir, firstly, on this NIM decline of 60-odd basis points on sequential basis, how much was the impact of this buffer liquidity which you carried through the quarter and also due to interest reversals? And how do you see our NIMs moving forward in the remaining 2-3 quarters, considering how our liabilities will reprice basis the actions that we have taken, the average tenor of bulk and of retail, how the liabilities will reprice, and also considering the fact that we had reinstated lending rate cuts from 1st April in microbanking. So there are multiple factors, but so you can just kind of clarify how the NIMs will incrementally move in the next 2-3 quarters, and what was the impact of buffer liquidity and interest reversals in Q1?
So Rajiv, there are three aspects to the change in the NIM. One is because of change in asset mix, which is to the extent of 25 basis points. Excess liquidity, which shall be absorbed in Q2 and Q3, led to a 17 basis points inflection. And one-off payment in microbanking, we had to refund prepaid installments, interest to the customers, which led to a 14 basis points hit on the interest income. So total is 56 basis points. If the points 2 and 3 were not present and only the change in asset mix were to be reckoned, then our NIM would have been around 8%, which is a gradual 8.3 to an 8% kind of a movement. So what we have done is peak FD rates have been cut by 65 basis points, and savings account rate calibration has also been done in a few buckets up to 100 basis points as well. So these aspects are going to lead to a reduction in our cost of deposits. It is already reduced by 21 basis points in Q1 over Q4. We see further reduction coming by to the extent of 30 basis points based on our plan. With CD ratio at 86%, we have excess liquidity to the extent of 11,000 crore, which is getting unwind now. We expect our NIM to be closer to 7.9 Q2, Q3, and stabilizing at 7.8% by the time Q4 comes.
Okay. Sir, 7.9 by Q2 itself?
Sorry, Rajiv?
Yeah.
7.9 by Q2.
Yeah, correct.
7.9 by Q2 because there are two factors. One is excess liquidity will get popped up.
Correct.
And the one-off payment won't get repeated. So you will see an immediate improvement to 7.9 and it will sort of stay there after.
And also just carrying forward this point of bulk deposits repricing, what is the average average maturity profile of bulk, and what is the current cost of bulk deposits versus what is the fresh rate in the market right now? What is the difference that you will capture in the next 1-2 quarters?
Yeah. Hi, Hitendra Jha here. So if you look at bulk TD, we are now sourcing at 7.69%, and average tenure is around one year.
Okay, 1 year.
And our retail, retail we are now sourcing at 8.09 Q1, which, as Mr. Nautiyal said, going forward it will come down.
Sure.
Yeah.
Sure. Just one last thing on collections. As I can see that the correct collection manpower has been off-roll has been ramped up in the last 2-3 quarters. Now, how does it reflect in our collection efficiency and the rollback and resolution efficiency in the coming quarters? Can you just kind of tell us what kind of an improvement would it lead to significant rollbacks? That is what the plan with this kind of augmentation in collection manpower.
So Rajiv, this increase in manpower will help us in two ways. One is in SMA collections and the second is in NPA collections. And that also includes write-off. NPA also includes, write-off collections because these are higher DPD. In terms of SMA collections, we had seen that the environment was not so good. So we had focused a lot on the early buckets. 31 to 90 is where most of our off-roll team is handling. And we have seen the collection efficiency in SMA 1, which is 31 to 60, improve from about 37% to now 47, 48%. And SMA 2 has gone up from about 42% to 45%. So a lot of our team is in the early buckets handling the slippages. And that has also shown us lower slippage. The forecast is also going forward much lower. In terms of NPA collections, we have seen an improvement, but in microbanking it takes time. There are 3, 4, 5 meetings over a couple of months it takes for NPA to start getting recovered. But Q1 has been better than Q4 in our NPA and write-off collections.
Okay, got it. Thank you. Best.
Yeah. Just Rajiv, just to clarify, excess liquidity to the tune of 1,100 crores, not 11,000 crores. And retail FDs, the peak rates have been cut now to 7.6. So approximately we'll see a drop. So Hiten sir mentioned about the quarter one average numbers. So we expect good amount of reduction there going ahead. Thank you.
Okay. Yeah, thank you.
Thank you. The next question is from the line of Sagar Shah from Spark Capital. Please go ahead.
Yeah, thank you for the opportunity and congratulations to the entire team of Ujjivan for decent set of earnings in such an environment. Sir, actually my first question was related to the asset quality. In this quarter we have around some few loans of which are insured against a CFG-MU scheme. So what I wanted to understand that how can we look going ahead that still we have around 649 crores worth of cover for CGFMU cover. So going ahead, are we looking to increase our cover in this going ahead? What is the strategy over here?
Hi, Sagar. Thank you for the question. Yes, we have started doing CGFU from the Q4 and we continued in Q1 as well. And we intend to continue this. This gives a very good coverage and we will continue to do as a part of the portfolio coverage going forward as well.
Okay, so at least till in the next 1 year that what percentage of the portfolio are you targeting to cover and in the next 3 years also are you targeting to cover 100% of your portfolio?
So I would not be able to give you percentage at this point of time, but we have select pool and we have science behind it and we will be covering some part of our portfolio through CGFU.
Okay, sure sir. Now next question was related. Sorry.
So okay. I was saying that CGFMU is a dynamic activity that we would be doing quarter on quarter based on the situation around.
Okay, so that will depend on the situation of the kind of the portfolio quality that you will be taking a call depending on that basically. Okay. My next question was related to Ujjivan plus 3 lenders, which constitutes, as per your data, it constitutes almost 7.4% of your total borrowers. And if I see the collection efficiency over the last, obviously, we know what the kind of environment are we going through, but the collection efficiency is constantly dropping. So when will we see this number stabilize? You already highlighted that we will see some recovery going ahead, but I wanted to exactly have some word about Ujjivan plus 3 lenders. How is the portfolio doing and how is your collection? How is your overall collection team actually helping out to recover dues from them?
Sagar, one of the reasons for a drop in collection efficiency is also because Ujjivan plus 3 and above has also dropped. This number last year was about 14%, and now we are in the range of about 7.4%. So
Right.
while the denominator has gone down, that is one of the factors which contributes to a drop in collection efficiency, because the good customers are finishing their loans and the delinquent ones remain. So having said that, it seems to us that it will take another 1 quarter to maybe 4 or 5 months for this portfolio to become insignificant. And that is how we are looking at the rundowns.
Okay, fine, sir. So my next question was related to OpEx. What kind of are we looking at increasing our branch network this year, and any guidance related to that? How are we looking to increase our branches across, maybe not in this year, but next year? Any guidance related to that?
This year we are planning to open around 25 branches, and over the next 4 years we may open around 400 branches. That is the overall plan.
Okay, fine, sir. And once this collection efficiency stabilizes, especially in this stress portfolio, do we see that at least the off-roll collection team coming back to normal by FY27? That will be my last question, sir.
Yes, Sagar. Post-COVID, this team was in the range of about 1,800 people. Immediately post-COVID, we had ramped up the team. We brought it down to 1,200 as collections, the stock came down. During this time, we felt that we needed to increase it, so we have taken it up. And progressively, as the stock comes down, we will bring down the team size.
Okay, so that will be one of the factors behind the low cost-income ratio, right?
Sagar sir, I'm sorry to interrupt. May I request you to rejoin the queue, as there are several participants waiting in the queue.
Yeah, fine.
The next question is from the line of Shailesh Kanani from Centrum Broking. Please go ahead.
Yeah, good evening, everyone, and thanks for the opportunity. So my question is first with respect to our housing segment. There, our book is now at a decent size, and we are seeing a good growth over there on quarter-on-quarter basis. One small data point over there, the SORP has seen a sequential drop from 96 to 94%. So I was wondering, what is that balance 6%? And if you can just kind of highlight any key monitorables in this book and key things which are going well for us in this book.
Shailesh, we also take commercial property when we do LAP. So there is some part of residential and commercial. While I can come back to you on specifically what was the 2%, but it could possibly be commercial property. We can come back to you on that. In terms of monitorables, we, in terms of asset quality, monitor a 99.5% bucket X collection efficiency. We also monitor our GNPA and PAR. Our GNPA has been in the range of 1.25% for the past few quarters. It is stabilized in that range.
And what things have gone right for us means the growth has been quite robust over here.
This is largely driven, Shailesh, by our distribution. So we are present in almost 550 branches of the 750 branches we have. And so the product is widely distributed. We have improved our distribution over the last 1 or 2 years. I would say that is the primary reason. The second reason is our price competitiveness. We also are competitively priced compared to the loans available in the market through competition. So these are, I would say, the two factors which help us service our customers better.
And in addition to what Ashish said, we also measure our sanction to disbursement ratio, which is close to around 90%, which is much higher than, I guess, the industry.
Thanks. That's useful. My second question, I was just seeing the breakup of JLG book in terms of exposure. West Bengal is above 15%, and I remember earlier our commentary has been that So it's very minuscule, 15.1%, but our commentary has been that we would be keeping it below 15%, any state exposure. Is there any change in policy over there or anything to read into it?
So yes, we still hold that we want to keep our microfinance portfolio within 15% range. And I think the data that you are looking at is only group loan. If you include IL also, it will come below 15%. But obviously, in the last financial year, we have been facing issue in South, especially Karnataka and Tamil Nadu. And we go, at this point of time, I would say from the last 2 quarters, we see that East and North has stabilized faster than other regions. And we have larger base there. We have a lot of good number of branches here. And this point of time, we want to grow there. As South also stabilizes, we will also start growing here, and you will see this ratio again changing.
Okay, that's helpful. Thanks a lot, and best of luck.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to address questions from all participants in the conference, please limit your questions to 1 or 2 per participant. Should you have a follow-up question, we would request you to rejoin the queue. The next question is from the line of Nikhil Vaishnav from Emkay Global Financial Services Limited. Please go ahead.
Thank you for taking my questions. So just one question from my side. You said about NIM, we have impact of some 17 days from one customer regarding the prepayment. So can you give some detail on the same, like, or who is the customer, like we have given this prepayment in loans, deposit, or any corporate customer? So can you provide some detail on this? Hello.
So yeah, it's nothing but, we in microfinance segment, there is a day of repayment because it is monthly repayment and it is based on day in the center meeting. And some customers tend to pay, 1 or 2 days, 3 days advance. And the kind of accounting that we have in microfinance system, the 2 or 3 day advance repayment, that interest benefit was to be transferred to the customer. And that exercise we have undertaken, and that small amounts have been transferred to the customers, and that is something which is going as a interest reversal because it was realized and then reversed.
Okay, understood. And secondly, sir, can you give some indication on your GNPA? Of course, it will be below 3%. But can you give some guidance or some indication on the slippages, how it will be going forward in Q2 and in second half, and also the credit cost?
So, in terms of slippages, these slippages have started to come down post Q4. In fact, as we said, Q4 was the peak in 9 out of 10 states, and Karnataka has peaked in Q1. We see the SMA book has, if you look at it, the SMA book has been steadily declining from 2.68% to 2.36 and now 2.29. So this means that the slippages going forward will be much lower than what we had in the past 2 quarters. So you can say that the GNPA would be contained below 2.5% as we go forward.
Okay, sir. Yeah, that's my question. Thank you.
Thank you. The next question is from the line of Abhishek from HSBC. Please go ahead.
Yeah, hello. Am I audible?
Yes,
Mr. Abhishek.
Yeah, thanks. So, few quick questions. So one is in the provisions of 225 crore. How much was for MFI? The quarterly P&L provision of 225 crore, out of that, how much was made for MFI?
Abhishek, I'll come back to you, but around 80% should be the figure.
Okay.
But I'll come back to you on this. We'll take this offline.
Sure. And in MFI GNPA, typically, what's the PCR you maintain approximately?
It's in the range of about 70%. That is the mandate that we have.
Okay.
We have used floating provisions, as you must have seen. We have also used floating provisions at a bank level for computation of PCR. So, in In our unsecured book, the provisions are slightly higher, and on the secured book, the provisions are relatively lower because they happen at the provisions increase at a much lower pace. Unsecured happens much faster.
Yeah.
So PCR on unsecured is about 80%.
Sure. On unsecured 80%. So basically, when you write off, you have to just make the remaining 20%. I just wanted to check that.
That is true.
Yeah. And in IL, how much is in Karnataka, and what would be the PAR of that book?
Sorry, Abhishek, you're asking about?
In individual loan, the individual loan book, how much of it would be in Karnataka, and what would be the PAR?
So in Karnataka, the book, our overall book is about 5,300 crore.
Yeah.
And Karnataka is about 10% of that.
Okay.
The overall PAR is 7.4% in Karnataka.
That is the IL PAR, individual PAR, book PAR.
That is the IL PAR.
And last quarter it would have been how much?
5 in the investor presentation.
Oh, okay.
It has increased from 3.8% to 7.4%.
Right. Okay, got it. Sorry, missed that. All right. And last quarter, the ARC sale would be mostly in GL, right?
No, it happened for both GL as well as IL.
So what would be the split roughly? Would you remember?
78% was GL and 22% was IL.
Okay, perfect. All right, thanks so much.
Thank you. The next question is from the line of
Abhishek, one correction. Karnataka, the PAR has gone up from 6.8 to 7.4. I mentioned erroneously 3.8. It is 6.8.
Thank you. The next question is from the line of Chinmay Neema from Crescent Capital. Please go ahead.
Hi, good evening. A couple of questions from my side. Firstly, could you give some color on what you're seeing in Karnataka on ground, and when do you see, or how soon do you see the PAR numbers coming down meaningfully or turning around?
Hi, Chinmay. About Karnataka, we are seeing improvement. Definitely, that is very, very clear. And the situation which in the industry was in the month of January has eased out a lot. We see a lot of improvement in Ujjivan portfolio as well. At a broader level, Karnataka has two geography in microfinance. We have Bengaluru Metro and rest of Bengaluru, the rest of Karnataka, you can say. Bengaluru was never affected for us. Bengaluru has been doing very well even during the month of January, February, March. And we have large part of portfolio in Metro. We are better than the industry. It is clearly showing in month-on-month data also in portfolio quality. We have excellent portfolio quality in Bangalore urban market, as I mentioned. We see still some kind of issue in certain districts like Belgaum, Davangere, Tumkuru and Ramnagar, which contributes close to 10% of our estate portfolio, and which is majorly impacted due to ordinance issue. Otherwise, state portfolio is doing excellent. We also see increase in demand in other pockets. With the ordinance issue subsiding slowly, new PAR addition has reduced across most of the districts in the state consistently and expect to improve further in the state. We have 24% IL book in the state, and it is performing far better than GL. And as the profile and income levels of these customers in the state is much better, and we will see continuous improvement in coming months as well.
Understood, sir. My second question is on PCR. The PCR has been coming down quarter on quarter. So is it primarily driven by change in mix towards the secured book, or is there something else to look into?
So the PCR has come down because the increment in GNPA was faster than the increment in provisions. now that the GNPA accretion has slowed down, the provision accretion will catch up, and therefore the PCR will tend to rise going forward. Number two, in terms of secured book, our PCR is low, and the GNPA accretion has also been very low there. So therefore, PCR has also shown a slight decline during this quarter for on the overall for the bank.
Got it. So out of those 775 crores of total provision, would you be able to share what is the provision earmarked towards the MFI book?
Hi, this is Gaurav. 775 is the total provision. 130 is the floating provision earmarked for this. So I'll give you the breakup of this. We totally have 181 crores of floating provision, out of which 130 is currently earmarked towards the calculation of PCR. We have another 30 crores earmarked for Tier 2 capital, and around 21 crore is unutilized.
No, I get that, but out of the total provisions, if you could share what are earmarked towards specifically the microfinance book?
There is no earmarking within the floating provision.
So that happens as per the provisioning policy. Are you asking for a breakup of this between microbanking and others?
Yeah.
Of the overall provisions or for the floating provision?
Overall provision.
Overall, we can come back to you, but broadly about 80% of the 80% is the PCR for microbanking book, and about 55% would be on the secured book. But we will come back to you on that.
Okay, sure. Thank you.
Thank you. The next question is from the line of Ashlesh Sonje from Kotak Securities. Please go ahead.
Hi team, good evening and congratulations. Firstly on the MFI book.
Sorry, you're not audible. Could you be louder, please?
Is this better? Hello?
No.
Can you hear me now? Hello?
Yes.
Okay. Firstly, on the MFI book, if I look at the performance of the group loan portfolio, that has seen an improvement in the PAR 1 to 90 bucket over the last 2 quarters. But if I look at the same metric, the 1 to 90 DPD for the individual loan book, that seems to be steadily increasing, both in percentage as well as in rupees, in the individual part. What is the reason for this divergence in performance?
So overall level, our IL book is doing much better than GL, and overall microfinance book is doing much better than industry. Within IL, we have been little bit impacted in Karnataka, as in Karnataka we were doing very well in IL. IL book size was also very healthy and large, and that has impacted to an extent. But what we have seen in the past also that in IL, even after delinquency, the recovery is much better than GL, and we see that this will come back and our portfolio will improve.
Okay, got it. And can you give a breakup of slippages across group loans, IL and non-MFI?
Yeah, just one second. Pull that. Yeah. So microfinance slippages approximately accounts for 80%. So roughly 300 crore slippages are from microbanking put together, group and individual. Housing is the rest around half of the rest, and MSME takes the another bulk. So roughly 25 odd crores for housing, around 20 for MSME, and around 5 crores for the vehicle vertical.
Got it. And within this 300 crores, how would it be split between GL and IL?
Around 220 to 30 crores of group loan and around 60 to 70 crores of individual loan.
Got it. Okay. Okay. Thank you. Those are all the questions I had.
Thank you.
Thank you.
The next question is from the line of Deepak Poddar from Sapphire Capital. Please go ahead.
Yeah, am I audible, sir?
Yes, Mr. Deepak, please go ahead.
Yeah, okay. Thank you very much, sir, for taking my question. So just wanted to understand, first up, I think you mentioned in the opening remarks that by third quarter, we expect normalized level of credit cost or collection efficiency. Is that right?
We mentioned about the collection efficiency in microfinance to be normalized by Q3. Yes.
Okay. So we expect 99% plus kind of a normalized efficiency, collection efficiency by third quarter, right?
Yes. Expected. Our current expected is 99, close to 99.4 consistently for last 2 months, and we expect to go beyond 99.5 plus collection efficiency in expected.
Fair. And about credit cost, when do we expect credit cost to come to normalized level? I mean, by which quarter?
So, increase in NPAs over the last 2 or 3 quarters is still to be fully provided. That we expect that during the next 2 quarters, there will be provisions on the existing stock. But post that, since our bucket X collection efficiency started to improve in Q1, the impact of that will be seen in Q3 and Q4.
So by fourth quarter, I mean, ideally you expect... Yeah, please continue.
Yes, I would say so. I would say so that by fourth quarter it would be normalized. So what gets into bucket X in Q1 starts to show an impact in Q3. So on Q3 we will see a reduced number because the efficiency started to improve in Q1.
Correct. I got it. So the NP increase in last 2 quarters, you have to provide for next 2 quarters. So ideally so we will see an improving trend at least. I mean, yeah.
Yes. In H2, one can say that the credit cost would be much lower than what we see in H1.
Correct. And what about second quarter? We can expect similar credit cost as we have seen in first quarter in this coming quarter?
So we can say that Q1 and Q2 would have credit cost. Q3 and Q4 would have much lower credit cost.
Okay. Yeah, I got it. And just one last thing, what's the normalized level of credit cost we are looking at? I mean, once this settles down, so in terms of percentage, what sort of normalized credit cost we are looking at?
So on unsecured, the credit cost should be in the range of 2 to 2.25%. And on secured, we see 0.7 to 0.8% on a steady state basis, minus this, disturbance in the environment that we are seeing now. So that is a steady state credit cost that we should see.
Okay. So since the book is 50-50, so maybe at a company level, we might look at 1.5, 1.7% kind of an average.
Yeah.
Okay. Great. That's very helpful.
Maybe lower.
Come again, sir? Hello?
Maybe lower than that.
Maybe lower than that. Okay, maybe then lower. I got it. Fair enough. I think I would like to wish you all the very best. Thank you so much.
Thank you, Deepak.
Thank you. The next question is from the line of Vinay Nadkarni from Hathway Investments. Please go ahead.
Yeah, just one bookkeeping question, sir. One is on the credit cost. For this quarter, what is the credit cost that you have projected for actual credit cost in quarter 1?
We have had a credit cost of 225 crores at a bank level.
As a percentage?
As a percentage of gross loan book, mostly around 0.7% non-annualized.
Okay. And secondly, in your projections, you have projected cost to income ratio of 67%. With an advance growth of 20%, you still expect the cost to income ratio to be high?
Yeah. See, just highlighting that you would have seen that, our newer verticals have started contributing to the top line. The micro mortgage, gold, vehicle, even MSME, agri banking. So we still are in the investment phase, and additionally we are also investing in the liability piece on the tech front, on the manpower front to, we want to work on our CASA. So the investment phase continues on, and hence we expect the cost to income to stay elevated.
Okay. And in terms of your projections for yield on advances and cost of funds, could you give us some direction for F26? for the full year?
So for cost of fund, we are expecting moderation by 20 bips, around 20 bips rate in Q2.
And advance?
Just adding that, so we have just done rate cuts in last 90 days. If you look at the way we have worked, so from April till July, we have taken rate cuts around 65 bips in our FD rates and also calibrated the SAR rates. We expect cost of funds to come down. Mostly it should come down by 20 bips each quarter as per our calculations, directionally.
And on advances?
Advances, you're asking about yield? Yeah, so see, yield mix will continue to come down with the secured mix, increasing steadily. But once the microfinance business starts to kick in by maybe Q3 onwards, maybe it will stabilize a bit before again further taking a downward trajectory.
Okay, and just on the...
I'm sorry to interrupt, Vinay sir.
Yeah,
may I request you to
please. Thank you.
The next question is from the line of Pranuj from JP Morgan. Please go ahead.
Hi, thank you for taking my question. So in your presentation, you have written that the new MFIN guardrails is only applicable for group loans. So in your individual loans, could you give a sense of how is the number of lenders lending on Ujjivan +2 or +3 and above on that particular book? And also with we are lowering the qualifying criteria for NBFCs, MFIs from 75 to 60%. Do you foresee a case where the competitive intensity in the individual loan segment increases? And so lastly, also, if you could give out the yield differential between group loans and individual loans. Thank you.
So on guardrails, yes, IL is, beyond guardrail 2.0. We don't need to apply that. But we have been applying even a stricter rule for IL because yield while graduation is something which we have been doing for last 15 years now. Very, very, well established and well crafted products that we have in last 15 years, which we have developed. So our policies are much stricter in IL. At the same time, the underwriting is very, very different in IL. That also leads to a better assessment of the customers. So that is not a problem. GL, yes, we have applied guardrail 2.0 in letter and spirit from April 1st and then January 1st, NCA and RCA. But IL is very different for us. IL we underwrite in very different way, and that is even stricter than the guardrails that we have in place. And as far as yield is concerned, IL yield is close to 100 basis points higher than GL.
Okay, it's higher than GL. Okay, sorry. So my question on IAL was coming out more from the perspective of like if you have some criteria where you underwrite the customer at the time of sourcing, it's also likely that because they don't under the guardrails subsequently after you have given the loans, the indebtedness could rise if they take subsequent loans from someone else. So it was more from that criteria and from a competitive intensity criteria also.
So two points here. First is that these customers, if they try to take GL loan as such, they will not be eligible because guardrail will apply. As far as IL is concerned, this is our historic data also, and historic data science also says that is a proper ticket size loans are given to this customer segment, and underwriting is done well. The propensity of these customers taking further loans is much lower compared to in GL. And this is something which we have seen over the period of time, and that also gives a lot of confidence in when you are dealing with this customer segment and when you are graduating customers. Second point is that, and that also shows in data that 79% of our customers are Ujjivan and Ujjivan +1. Yeah.
Okay, got it. Thank you. That's helpful.
Thank you. We have our last question from Mr. Shailesh Kanani from Centrum Broking. Please go ahead.
Thanks a lot for the follow-up. So just one point you mentioned that our PCR would increase going ahead. So any ballpark number, would we be going back to around 80% by the year end?
So we would be hovering in the range of 75 to 77% during the course of the year.
That is what the projections are telling us. We still would have 21 crores of unutilized provisions that we are not using for computation of PCR. So that's over and above the 75, 76 range that we are talking about.
Okay, sir. That's very helpful. Thanks a lot, and best of luck, sir.
Thank you. As there are no further questions from the participants, I now hand the conference over to Mr. Shripal Doshi for closing comments.
Thank you, Vinay. Thanks to the management of Ujjivan Small Finance Bank for giving us the opportunity to host the call. And thanks to all participants for being there on the call. Thank you all and have a good evening.
Thank you so much.
Thank you.
Thank you.
On behalf of Equirus Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.
If you found this video helpful, please like, share and subscribe for latest upcoming videos.